Good evening, all. We just wait for a minute or two for our participants to join in, and we'll start off very short. Yeah, I guess. Good evening, all. Again, hope all you had a very good festival time. To introduce myself, I am Rahul Sejwal. I lead the Mumbai region on business development front for ASK Investment Managers. On behalf of ASK, let me welcome you all for this call on ASK Vision Portfolio. Vision portfolio has actually completed more than 3 years now, and for the last 3 years, the CAGR returns have been about 18% odd. Of course, last year was a tough one on the portfolio front, but we have seen some decent comeback in the last 6 to 9 months. So to discuss this further, we have with us our portfolio manager, Mr. Kuldeep Gangwar. Kuldeep, just to introduce Kuldeep, Kuldeep has been has an experience of more than 18 odd years, with more than 15 years into equity space itself. His experience in terms of equity research has been more than a decade. His domain expertise more into consumer sector, more FMCG and retail. Prior to being with ASK, he has been associated with HSBC Securities. He has been associated with Capital Markets India Private Limited on the research part of it. In terms of his overall education, he has been an MBA Finance from IIT Bombay. He has been he has done his BTech from Electronics and Communication from IIT Roorkee, and also is a CFA chartered holder. He's been more than 5 years now with ASK. Before handing over to Kuldeep, would like to mention that you can type in your questions in the Q&A section, and we can just try and collate as much as possible and try to answer them all. Over to Kuldeep, to brief us on the portfolio front, how it has been in the last quarter, what has been the broader trends that I've seen in the market, and the recent changes in the portfolio in terms of how we are aligning onto the market front. So over to Kuldeep. Kuldeep, you need to unmute.
Hello, everyone. Thanks for joining in. So, before coming to the portfolio, it's always a requirement in the current context that how the world is behaving. And if we look the overall market perspective, then probably we are in this country which is doing much better than others, and it is also reflected in the portfolio, or say overall market performance, whether it's a CYTD 1 year, 3 year, 5 year. So pretty good in terms of the stock performance, and it was backed by the strong earning performance as well in last 3 year or 5 year. If you look the discussion which is happening for last 1.5 year, it was revolving around that in which direction the world is moving, many moving parts in terms of say geopolitical situation, macro worsening because of the same. So since last 1.5 year, you might be listening that inflation is a key concern to which most of the central banks are trying to respond. But the way we understand now that the worst is over, in a sense, like if the current slide is visible to you, then you can have a look like if October 22, the inflation figure was running in high single digit or low double digit for most of the developed market economies. Now that is relatively better in control, like low single digit for most of the developed market. So the issue persists, but probably the worst is behind. And now the narrative should be either neutral to marginally positive in time to come. Because most of the commodities, whether it's metals or agri, those have come down significantly from their peak. Like on the agri commodity part, wheat has come down almost 30% from its peak. Palm oil has corrected more than 20%. If we think about, say, aluminum and steel, etc., everything has corrected more than 15% or so. Oil, which had been a key cause of concern for almost 2 years, like it has risen significantly, particularly post, say, Russia-Ukraine war. It has come under control, and like a significant correction happened from last year peak of USD $128 per barrel. In recent time, when you would have noticed that Israel and Palestine war started, then there was a shot up like almost 34% up move in the crude oil. It has corrected from that level, and things are again coming back into the control. So net, if you look this particular chart, it's quite visible that whenever there is inflation, most of the central banks try to respond to the same. And from this year beginning, if you have a look, then it's having a declining trend. And if we think the response perspective, our understanding is that large part of the pain is behind, and in terms of tightening, probably we have reached to the peak, and probably next year, say second half, we should have some interest rate cut in the global economy. So it's more of a delayed stuff, not denied, and we will like to believe that whether it's inflation, macroeconomic concern, or reasonable stability should be there when we will be venturing into the new year in CY24. US 10-year government bond yield, as we mentioned that crude oil had up move, say, a couple of months back, moving again back to more than $95. It coincided with the 10-year bond yield in the US moved to more than 5%, and which rattled the equity market. It has again started moderating and again came down to almost 4.5, 4.6%. So we can say that some sort of stability is coming back. If we think about global indicators, situation is improving. And if we think about domestic, things are looking reasonably well and stable, like diesel consumption, petrol consumption, which are actually reflection that how the broader economy is doing. So volume are up 5% YOY in October 23, and petrol demand is up 9% YOY. Train traffic has also moved up almost 6% YOY in say October 23. Air traffic is up 11% YOY in October 23. All these things are pointing that our economy had been resilient all through and moving its march upward. And from the economy perspective, from ecosystem perspective, we should be relatively more resilient, more stable, and if I have to say so, probably the good time ahead for whatever the foundation work we have done in last 3-4 years. From the consumption perspective, like credit card transactions have gone up, spend have gone up. It all suggests that economy in our country had been relatively in better shape, despite a lot of headwind which we have faced in last couple of years. And that's the reason we are quite optimistic that from macro environment perspective, we are in much better shape vis-a-vis what probably we used to be, say, in pre-COVID scenario and so on. Same is the case with CPI, like what we have seen for inflation globally. Similar trends are being observed in our own country, like CPI index is suggesting that our own inflation is moderating. We had say sharp up move in July because of, say, vegetable prices going up and so on. But now the things are looking better in control. So global macros, domestic macros is one part. Equally important are like how the equity flows. So you will recall that from October 21 onward, there had been flight to safety by many foreign portfolio investors. which led to, say, withdrawal from Indian equity market. And that's the reason the equity market performance was quite subdued, despite that on-ground earning delivery was quite superior in last 4 years. Like if you look up by 19 till 23, at the market level, the earning growth was almost 18 to 19%. And despite that, overall market return was relatively muted. But it had more to do with this technical part that foreign portfolio investor withdrawing the money. And from March 23 onwards, we have seen that they are coming back. It resulted in that buoyancy for that high quality, high growth, and the overall market also coming back. As every crisis brings some positive part as well. So you would have seen post-COVID, there is always this SIP part moving upward. And as we speak, SIP has already increased to almost $2 billion a month. So it's a quite sizable number, a counterweight to, say, a foreign portfolio investor. And that's the reason we have seen a significant stability despite the chaos being observed globally. And this is the GDP forecast for major economy, and probably India remain a bright spot. It had been a bright spot for quite some time, and same should be the case for this year or the coming year as well. Like if global economy will be growing at 3%, India should grow at more than 6%. So India will be key growth driver for the overall growth global growth as well. As I mentioned that we are probably in much better shape because our earning trajectory has improved quite a lot from FY20 onwards. So post-COVID, if you would have seen that our earning have almost doubled in 4-year time frame, and it's happening after quite some time. So though there are many up and down which we are observing on month-on-month basis or quarter-on-quarter basis, but at the same time, the confidence level that we are okay as far as the fundamentals are concerned, and equity market will follow sooner or later. So this is the market performance. Like it has more to do with how the annual corporate profits are moving up. So whatever we have seen in terms of the market up move, it is well supported by, say, corporate profit going up. So in about 21, 22, 23, there's significant improvement in the overall profitability of the Indian corporates. From the valuation perspective, we will like to believe that the valuation are quite reasonable because in last 2 years, though the earning have compounded almost 15% plus CAGR, but the stock market had been relatively stable, and which led to a situation that as we speak, say forward P multiple look quite reasonable, like probability that it's coming down from here downward look relatively lower. A summary of the Q2 FY24. So margin expansion has driven the earning growth while export remain a drag. So if we think about the Q2 FY24 overall, capex-led volume growth was quite visible. It was quite visible in case of steel and the cement consumption growth. Domestic consumption was relatively muted while export remained a drag. As far as the consumption is being concerned, we will have to dissect the Q2 in two parts because in the Q2, at times the festive plays its role. So last year, Diwali was earlier, and that's the reason the domestic consumption had a base which is not so comparable, if I have to say so. So Q3 FY24 should be relatively much better this year because of the festive season related purchase in the consumption will be happening in Q3 FY24. As far as the financial services are being concerned, that most of the companies delivered the number in line with expectation. Chemical and pharma intermediates witnessed pressure because there were lower exports as well as there was compression in the spreads as well. IT earnings were muted, but it was in line with the expectation that based over the global developments which we have seen, whether in US or Europe, it was bound to happen that IT earnings may remain subdued for some time. Pharma companies reported better than expected results, which was supported by stable volume on the domestic front, and margin expansion as lower input costs helped the overall margin. Auto sector benefited because of the operating leverage as well as the benign input cost. Consumer discretionary, as I already mentioned, that there is a shift in the festive season. So the good part of the consumption should play out in the Q3 of Y24. From the market outlook perspective, managements are quite upbeat that consumer demand should start improving from Q3 of Y24 onwards. Capex likely to sustain. Chinese exports accentuated the impact on export volume in HY24, and the commentary suggests that there should be better outlook from Q4 about 24 onwards. As we have seen in the first half of about 24, that input cost is benign, which is helping margins across industries. It should continue even in the second half. We will be watching the upcoming Rabi season, that how it plays out, because adverse monsoon had some impact on the Kharif. And another factor to look out for will be evolving geopolitical situation. As I have already mentioned about this particular part, that if we think about equity long term, then it may appear that the earnings grow and the stock markets respond, and they'll go hand in hand as far as the long term is being concerned. But there is always lead and lag. There will be phases when the earnings do better than the price performance and vice versa. If we think about last 4 years, like FY19 till 23, the earning growth performance for the overall market was quite strong, almost 19% CAGR. But the stock market performance was relatively lower, close to 11% CAGR. And in last 2 years, you can say only mid-single digit CAGR would have happened at the overall market level. Because the stocks were not behaving and the market was not responding, the valuation have become quite comfortable. If we think about, say, long-term perspective, we do believe that for next couple of years, the earning growth should remain quite strong. Like at the market level, we expect like 15% plus earning CAGR. And in that scenario, if we believe the probability that the valuation coming down from here onwards will be relatively lower, then a decent part of the earning growth should convert into the overall stock market return. If we come to India Vision portfolio, so this is a snapshot like how the companies have delivered from the fundamental performance perspective. To create alpha, the earning alpha is a must, and this is something being delivered by our companies on the ongoing basis, whether it's about 23 or last 5 years. Say, earning CAGR for our portfolio companies was on an average close to 22%, with say Nifty close to 16% CAGR. Q2 about 24, the earning growth was 30% plus in the operating profit terms, and more than 35% plus at the PAT level, vis-a-vis Nifty PAT at close to 28%. For FY24 and FY25, we believe that portfolio should deliver quite a strong earning. Like in FY24, we expect almost 26% earning growth, vis-a-vis at Nifty 50 earning growth of 13%. In FY25, we expect almost 25% earning growth, vis-a-vis say 15% earning growth for the Nifty. India Vision portfolio positioning perspective, like we are overweight in certain areas, consumption, on manufacturing and engineering. So financial is quite close to where the BSE 500 would be, but more in favor of say NBFCs and general insurance. From the consumption perspective, we have exposure toward beverages, building products, retail, staples, relatively significant overweight position in that particular area. Manufacturing is again a quite overweight position, like almost 12% of the portfolio, vis-a-vis 1% in the benchmark. Chemical and is the sector where we have brought down our positioning. Auto ancillary is having some overweight position over there. Portfolio psychographic, like as I already mentioned, that earning growth should remain quite strong for about 24 and 25. From valuation perspective, they have become quite reasonable in last couple of years. Return on capital employed remain quite robust, like more than 30% over there. If we look, say how the trailing P has behaved for this particular portfolio. So this particular portfolio has seen many crises in last 4 years, like it has seen that COVID-1 happened, then the COVID-2 happened, then the Russia-Ukraine, then in recent time, Israel and the Philistine war over there. And one thing is quite clear that as we speak, the valuation are quite close to the trough. Like we all know that whether the portfolio return or stock return is combination of two things, how the earning is coming and how is market responding to the same. So stock return, portfolio return are nothing but earning growth and what's happening to the valuation part. So in last 2 years, we have seen the significant valuation de-rating. And today the valuation are quite close to the bottom being experienced in last 3-4 years. So probability that the valuation having a further contraction looks relatively lower. If that is the case, then in coming quarters, coming years, the decent part of the earning group should translate into the stock return. This is a summary like how the portfolio has done in last 1 month, 9 month and year. Interesting part would be like this is the same portfolio which we have used at the AIF platform as well. So as I have spoken even in past that if we look 19, 20, 21, those were the good years. CY22 was a difficult year despite the companies delivering quite a strong earning growth. In CY23, again the things are coming back. So whether it's a CY23 means like Jan 23 till date, there is almost 3% alpha. And if we think about FY24, almost 3% plus alpha over there. So for long-term basis, the portfolio, the philosophy has delivered. CY22 was a difficult year, and we are coming back and trying to make up for the lost ground. So what has not worked in last 1 year? So like Page, Naveen, Bajaj Finserv have not worked. But at the same time, like Naveen, we know because of the management change, there had been some correction. Otherwise, from earning growth perspective, the things look okay. And whether it's a Bajaj Finserv, the earning growth had been quite consistent. And we believe that the stock should behave in the desirable manner, in the favorable manner, time to come. Polycab, APL Apollo, Chola, Radico Khaitan had been the key contributor to overall portfolio performance since last 1 year. So Polycab has done quite well. Same is the case with Chola, Radico, etc. In summary, in last 5 years, we are seeing a very uncertain macro environment, like multiple challenges are coming at regular interval. So a portfolio has to have both the component, like ability to defend when the things are not working and ability to participate when the going is good. So we believe that it's a good mix of the portfolio having a decent exposure towards say consumption and other names which withstand the pressure when macro is difficult. At the same time, there's decent exposures toward the financial, manufacturing, infra theme, where we believe if economy is delivering, overall market is conducive, then they should accelerate the overall performance, both fundamental perspective as well as the market return perspective. As far as the India Vision portfolio is concerned, it's having trade towards the domestic branded distribution oriented businesses, financials, and having a decent exposure towards the manufacturing. All in all, the overall portfolio performance should remain resilient. Why we believe so? Because despite having multiple challenges in last 3-4 years, earning growth were coming, whether it had been difficult year of about 23 or prior years. So for last 5 years, as I mentioned, more than 22% earning growth, which suggests that on ground the things are delivering and the appreciation of that delivery is delayed, not denied. I will stop over here and happy to have any question which you might be having.
Yeah, thanks a lot, Kuldeep. I'll just remind the participants, the clients, to type in their questions in the Q&A box. I think, Kuldeep, what I got from you is, to a large extent, globally, if we see inflation is more or less moderating, You have domestic consumption, which is staying strong, and rightly mentioned into the consumption pattern that you mentioned. 19 to 23 kind of a period, there has been earnings growth, but of course, in many of the cases, the price movement has not as yet followed. And considering our portfolio, earnings were strong, but the price movement has not been happening in the last year, which seems to be catching up in the last 6 to 8 months kind of time frame. And going forward, also, obviously, we should be able to do so. So I think that was a little bit of a gist of what you mentioned. There were a couple of questions from my end itself. Specifically, if we talk about the portfolio action, in the last quarter, we've added two interesting names. One is Sai Sales and one is JSW Infra. I think would just like some input from your end and what is the thinking and how these businesses are going to pan out for us.
So if you think JSW Infra, it's a number two port player in the country. It's coming from the JSW group. So almost two-thirds of the business come, say, which is more of a captive in nature. Because JSW group itself is expanding quite fast. So it ensures that JSW Infra should get good volume from the parent company itself or the group companies itself. The third party business is almost a third now, growing at relatively faster clip. If we are saying, say, manufacturing should do good, infra should do well, then the port as a business should thrive. So it's a call on the overall infra space, say, manufacturing space in this country. And we are quite optimistic that the earning growth, volume growth should be quite strong in this particular business. Second is like Sai Silk, which we added. Sai Silk, we know saris is a probably southern market dominated category. At the category level, it may appear that it's a relatively slow growing category, but significant transition is happening from unbranded to branded, unorganized to organized. So branded players are growing relatively at a faster clip. Sai is among the top three players over there. They have raised the money to have a faster retail expansion. So if Sai used to have close to 50 stores till FY23, they will be having almost 30 stores in next 2-3 years, which should ensure more than 24%, 25% growth in next 3 years. And given the valuation was quite reasonable and that coming from a consumption area. So we are thought like this is the place we should participate.
Noted. We have a question from Mr. Amit. He's mentioned about based on Q2 and H2 results so far, have there been any upgrades or downgrades to our portfolio companies?
So for many companies, either our numbers are coming in line or better. They had been only one or two incidences where the number had been relatively lower than expectation, like Page Industries number were relatively below expectation. It had more to do with two parts, that the demand condition overall are relatively weak, as well as the company is doing the supply chain changes at on their own end. So because of the demand scenario, the Q2 looks relatively weak, and as we have seen for many retail companies, festive season getting delayed, though there could have been some impact. But whatever the Page has done in last 1 year, the benefit of the same should be visible in coming quarters and the coming year. As far as the positive numbers are being concerned, so whether it's a JSW Infra, size, those companies delivered quite a strong number. Financials were quite in line, whether we think about say Bajaj Finance Twin or say ICICI Bank, HDFC Bank, delivering quite a strong number, including say Chola. So net, I would say like earnings are tracking well in line with expectation, and the conversion of the same should happen in time to come as far as the stock returns are being concerned.
Okay, duly noted. I think I hope Amit that was answer to your question. Specifically, I think on a sector, chemicals as a sector you mentioned has been a bit of under stress, and we have our exposure towards SRF and Navin. I think you mentioned about trimming down our exposure a bit. What's your outlook on this sector going forward? Are you still holding this, or I mean, I know you cannot take possibly information on moving out or getting into a new stocks. But overall, sector-wise, what do you believe? How does this sector should do?
So if you look overall chemical sector, we used to have relatively much higher exposure. Like we used to have Aarti, Naveen, and SRF combined. Uh, we exited Aarti quite some time back. SRF, we have trimmed the position. If we think about the chemical sector overall, we believe whatever is happening at the current juncture, um, it's more short-term pain rather than say long-term opportunity having an issue. In fact, post-COVID scenario, chemical has become a sector which is moving from say commodity character to a more compounded area, like having a long-term visibility. In short term, we are seeing all this pain because the supply chain destocking is happening. End users are having the weak scenario, particularly in Europe, etc. So in our understanding, it's a more short-term pain. At the same time, we have calibrated our say exposure and did some trimming in that particular area. But otherwise, we remain relatively positive that from say medium to long-term perspective, this sector should deliver.
Okay, so I guess that's why our exposure still into these particular stocks.
Yeah.
Coming to let's say different question. Do you see some new age kind of stocks getting added? The reason I'm asking is because you've seen sectors like defense, sectors like renewable energy getting a lot of traction in the last year or so. So should we or would we be able to in future maybe look at these kind of spaces as well?
So we keep on evaluating the areas which can bring in both growth uh, in our area of competency. So, like as I mentioned, the JSW Infra is being added. So, just to address that part, that whether it's a port, overall infra space, that should do well. And this was in addition to our existing exposure of something like APL Apollo, which we are holding for quite some time. And over a period of time, we had taken the Polycab as well. So net, we wanted to have better presence in the manufacturing domain. That's the reason these three names were taken over there. Um, as you mentioned that they are the new areas which are evolving, and we keep on evaluating those areas as well. As and when it look appropriate to introduce those names, they can become the part of the portfolio.
Got it. So we are still open to the ideas whichever actually go through our overall rigorous system of selecting a stock. So good. I think one last one from me, considering the future part of it. Already you do mention about the earnings being in the excess of 25-26%. Will this portfolio be able to cover up the gap up? I think what has happened in 22 last year, a couple of years later on, will it be able to hold on to the fort and bring back the same kind of performance that you always had?
So, as I mentioned in the beginning, to create alpha, first the earning growth alpha is must. Like fundamentals that should be in place, the company should deliver on ground, and then the appreciation of that earning follows. So, in FY23, the irony was that the portfolio still delivered more than 20% earning growth. It did not translate into the stock return, and it led to a situation that the valuation have become a lot more comfortable. As I mentioned, that future return combination of two things, like what's happening to earning and what's happening to the valuation. Earning growth perspective, we are quite confident that in FY24, more than 25% earning growth, and similar should be the case in FY25 as well. As I mentioned, if the valuation have become quite reasonable, and then decent part of the earning growth should translate into the stock return. But at the same time, I would like to mention that it's always having some probability quotient, like the things move very fast, as we have seen in last 3 months. All it's sudden, Israel broke out. So as long as a stable environment is being concerned and earnings are coming, it has to convert into the stock return sooner or later.
And thanks for the answer. I think I'll still wait for a minute. If we have further questions from our participants, please drop your questions in the Q&A box. We're more than happy to answer. Kuldeep, just let's wait for a minute.
Sure.
Yeah, we have one more question. What are the risks in the near term that could impact the portfolio? This again is from Amit.
So, as you've seen that recently, when this war broke out, like Israel, Palestine one, it led to a situation that all of a sudden, say, crude oil prices moved up by almost 20%. And then again, the concern related to inflation, what the response the central banks would be having, and whether the interest rate moves up, those things revisit. But as I mentioned, that a large part of the pain is behind. Like most of the central banks had significant up move as far as the interest rates are being concerned. So almost 500 basis point plus for US Fed. The probability that the rates moving from here onwards looks relatively lower. There may be some short-term, say, knee-jerk reaction if all of a sudden any issue may crop up. But as long as the economy is resilient, global environment relatively more stable, um, it's more of a delay rather than anything getting denied over there. So these macro events may be the one of the factors to look out for. And second, maybe like obviously, the state elections have either recently concluded or going to have the results in the ensuing week, like on 3rd of December. So that is one of the event which will play out, and in next 6 months or so, we will be say looking forward what's happening in the central election and so on. So those outcomes may have some bearing in the short term, but from the economy perspective, we like to believe that we are in much better shape as far as the fundamentals are being concerned, like whatever we have done in last 4 5 years. So the benefits of the same should be visible on ground. So these are the few concerns which may crop up at any given point of time, and that's all.
There's one more question wherein RBI is asking banks to increase risk weightages on retail loans. Specifically, I think the recent news came in. It's related to that. Okay. So is it a cause of concern for the banking industry? What do you believe in?
So the way I think about it, like we are more preemptive in nature rather than reactive. So globally, if you would have tracked all the crises in the last 3 4 years, many people would have taken shorter. As far as our own case is being concerned, we take very calibrated approach and very disciplined about it. So before a problem occur, they think whether we can do something about it. Like so that's the reason they want to have some tab on this unsecured lending, and it's not that the wholesale say risk are emerging and so on. So unsecured lending was one area where RBI is suggesting some caution. And what will happen because the risk weights will go up, or say asking rate of the growth will go up. As far as the genuine demand is there, the companies or the banks will be able to pass it on. So it's a word of caution rather than undue concern, the way I will put it.
I think duly noted. I think that's about it on the questions front. I think okay. One more last question coming in: is microfinance sector as a high risk owning to unsecured lending?
So, as you know, like this is one of the relatively untapped opportunity, and whenever the easy funding is available, people want to go to that particular route. And that's the reason whatever we are seeing at the current juncture, like whether RBI trying to address the situation. So genuine demand do exist, but at the same time, discipline is required. And that's the reason I think about the RBI just trying to have disciplined aggression as far as the MFI lending is being concerned.
Okay, I hope Amit that answers all your questions. Yeah, thanks a lot, Kuldeep. I think thank you all for being present here, and hope to see you in the next quarter.
So thanks a lot, everyone. Have a
Take
good
care. Have a good day.
bye.